We'll go ahead and begin the webinar. Welcome everyone to the Kimberlite webinar to take a comprehensive look at the wellheads, cementing, and liner hangers market. My name is David Batt, President of Kimberlite Research, and I'm glad you can join us today. This is the 25th webinar in the Kimberlite webinar series that we've hosted on behalf of the oil and gas operators who have participated in our industry research. These webinars are provided as a professional courtesy and a thank you to the many oil and gas operators worldwide who participate in the Kimberlite industry surveys. Our past webinars have included reviews of many of the oilfield products and services most commonly used in the industry, such as directional drilling, hydraulic fracturing, artificial lift, and many others. And recently, we took a comprehensive look at the performance and the competitive positioning of the big four oilfield service companies, SLB, Halliburton, Baker Hughes, and Weatherford, along with a deep dive into the Permian Basin. Let us know if you or your colleagues need access to any of these prior webinars. Just send us an email or a chat message today. Also, we often collaborate directly with oil and gas operators worldwide. So we're glad to provide customized presentations to your company as needed. Just let us know. Today, we'll be taking a deep dive into the wellheads, cementing, and liner hangers market. Feel free to submit questions as we go along, and we'll try to address the questions during the presentation. For those of you that are not familiar with Kimberlite Research, I'll provide a brief background and then dive in. Each year, Kimberlite invests about 20,000 hours calling and qualifying users of oilfield services globally. This results in about 3,000 one-on-one phone interviews with users of oilfield services. Some of you in the webinar today may have participated in one of our prior industry surveys in the past, and for that I say thank you. Our research is about 50% North America and about 50% international and can be segmented. We produce a series of industry reports ranging from formation evaluation, interviewing G&G folks, drilling engineers, completion, production, and subsea. And today, we'll be focusing on the cementing services, liner hangers, and surface wellhead markets. These are based on interviews with 300 drilling engineers and managers across 192 oil companies worldwide. And the performance trends that I'll be sharing with you in these product lines from 2016 through 2022 are based on 2,000 customer interviews and based on over 80,000 supplier performance ratings, providing the basis for the analysis. The data set is rich and multidimensional. In this particular exhibit, we cross-plot supplier performance on the x-axis versus pricing competitiveness on the y-axis. We'll be spending a lot of time on this value map today, so I just want to make sure everyone's familiar with these four quadrants. So this is a visual picture of the competitive landscape, and any oilfield service company provider that plots in the top right-hand quadrant is viewed as a premium supplier, one that offers good service, charges prices a little bit higher than industry norm, costs more to be worth it. Bottom left is a discount quadrant, where perhaps don't perform quite on par with industry norm, but attractive pricing delivers a good value. You get what you pay for, and this is the fair value fairway that runs diagonally. Any oilfield service company that plots in the bottom right is viewed from the operator's perspective as delivering good value. Top left, value disadvantaged or competitively disadvantaged, and any supplier in the top left-hand quadrant really needs to focus on performance improvement plans in order to protect and defend their position in the marketplace. So with that introduction, we'll go ahead and dive in. I think maybe one of the first places to maybe start today will be with just the general activity in the market. You know, there's been a lot of changes and dynamics in the market right now. And while we still see continued growth internationally and offshore in the double-digit range, our forecast for drilling activity in U.S. land has been decreasing. About 8 months ago, our first views for 2023 were to drill about 17% more wells in 23 versus 22, and that number's subsequently been continuing to decrease and might well go below 10% potentially Right now, the low prices of natural gas will have drilling rigs and frac crews rotating out of gas basins and rotating into oil basins. But overall, we still see a pretty strong market that's supported by current policy that supports higher oil prices. And so it's still a very healthy market for the oil and gas industry for 2023. I think it's important to keep in mind in U.S. land that even though our growth is moderating down to about 11, 12% and could go below 10% before the year is out, potentially, depending upon which way things play out, we are coming off two very strong years of growth of 36% in 22 and 28, 29% in 21. I also think it's important to keep in mind that not every oil and gas operator is increasing their drilling expenditures. You can see here in this diffusion metric map that 57% of operators globally are planning to increase expenditures in 23 for drilling, and about the other third are planning to hold things flat. So if you take a look at the diffusion indices, you see the wild volatility our market has traveled from unsustainable lows from COVID to unsustainable highs recently. And even though we see the diffusion indices and operator sentiment moderating down a little bit, it is moderating down and still remains at relatively high levels around 75, which are well above the critical 50 mark. I'd also keep in mind that another trend that we're seeing is an increase in exploration activity. Oil and gas operators are wanting to go search for those long life reserves to help restore production capacity. We've had underinvestment in this industry for the last 7 years. Now, this has pronounced impacts to the oilfield service community because a lot of these exploration wells will require higher end technologies and science to help evaluate the drilling and the formation evaluation of these wells. When you take a look into ESG, which is another topic I'll touch bases on since it's kind of a key area, we do see some moderation in ESG. Certainly some of this is due to the mainstream media and some folks waking up around the world about ESG. But overall, the operators, about half of the operators are continuing to invest in ESG, mostly around the E, and most of the investment seems to be around emissions monitoring, reduction, and carbon capture. We continue to see that Schlumberger, or SLB, is viewed as the supplier that's best able to help the oil and gas operators meet their ESG objectives by about a 3-to-1 margin. This observation strengthens in the deep water amongst the subsea operators. And obviously, carbon capture is leading the pack in terms of new energy investments because carbon capture has a viable commercial model thanks to the 45Q tax credits. And at the end of the day, economics and shareholder returns do matter. Many of these other areas, including solar, not mentioned here, is driven by government policy and funding in many respects. So the long-term longevity of some of these other energy technologies will really depend upon the funding and the continued subsidization by the government. When we look at pricing trends moving into 2023, we had tremendous inflation taking place in 21 and 22, and we saw strong pricing increases. Right now, we're anticipating prices to increase in 2023 at about in that 7, 8, 9% range, but certainly probably below 10% overall, and pretty much in line with with inflation. We also see that as a result of a tightening market for oilfield service capacity, the major oil companies in particular and the national oil companies are really beginning to emphasize more and more access to quality service and quality technology in the selection and recommendation of oilfield service company suppliers to make sure that they have the resources and access to qualified people and equipment to meet their investment growth strategies. Oil companies around the world are having to invest, by and large, to help restore lost production capacity over these many years. And the truth, remains that oil demand will continue to increase, probably growing by at least 1 million barrels a year for the next potentially 20 years. So even though we consume slightly over 100 million barrels of oil a year today, it's likely to grow to as much as 120 million barrels of oil a day over the next 20 years. You couple in with that the 5% decline rate on existing reservoirs, you quickly begin to realize that an imbalance has formed. And with capital discipline by both operators and service companies, I think the more collaboration we can have between the oil companies and the oil field service providers, the better we can balance and ensure that all the resources that are needed in order to meet the investment moving forward will be there. This transition into surface wellheads, when we ask the drilling engineers and managers around the world, where do you most need improvement from surface wellhead suppliers? It's an open-ended question, and the operators are available to speak openly and freely. But availability, delivery, and lead times is still at the top of the list. Keep in mind that all of these interviews took place in the fourth quarter of 22, and these results and findings were published in January of 23. So as I talk about tight capacity for oil field services, we see this manifest itself when we ask the drilling engineers and drilling managers for surface wellheads. It's true, improved designs and improved access to better competent personnel is also near the top of the list, particularly in the United States land market, because remember, in the United States land market last year in 2022, we drilled about 35% more wells than in 21, and that put a strain on the entire supply chain, not just for equipment, but for access for competent personnel. If we take a look at who has the strongest market and brand images in the marketplace for wellheads, typically what we find is that Schlumberger SLB has a brand image with these positive correlations that basically translates into the realization that SLB is viewed very strongly, not just by their customers, but also by non-customers, as being a leader when it comes to critical service applications. SLB is not viewed as a discount provider, reflected here in this negative correlation. The 0% area tends to line up with Schlumberger's SLB's customer base, indicating that Schlumberger's customers view them very strongly as leaders in service. Conversely, if you take a look at TechnipFMC for surface wellheads, what you'll find is that TechnipFMC's image of leadership is pretty much aligned with their customer base. So the customers at TechnipFMC view TechnipFMC very strongly as being strong in these areas of performance. But their image of leadership does not necessarily propagate or extend beyond their customer base. TechnipFMC is also developing a brand image that being viewed more as a low-cost discount provider, and this image is also carrying over into the subsea wellhead market as well for TechnipFMC. If you look at Baker Hughes for surface wellheads, you find that Baker Hughes' strongest brand image is for being a discount provider, and as you know, Baker Hughes' presence for surface wellheads is now international as they sold their assets to Vault and Pelican in North America land. When you look at the subsea wellhead market for Baker Hughes, you see they have some brand image deficits to where even their current customer base does not necessarily view Baker Hughes as a performance leader in these areas, and they traditionally have also a more of a lower cost image and discount provider image in the marketplace. Drillquip for subsea wellheads tends to rate very favorably and be viewed very favorably from a brand image perspective for service and for being a value-based lower cost provider delivering good value. In Cactus, the market share leader in U.S. land for surface wellheads tends to have a strong image for being a low-cost provider, but their pricing strategies are inconsistent, where some operators view them as being a low-cost provider, some view them as being cost more but worth it. But overall, Cactus is pretty consistent in being viewed as delivering industry-leading service, while their pricing discipline and their pricing strategies are not very consistent at Cactus. So if you just do kind of a comparison in U.S. land for surface wellheads between Schlumberger, SLB Cameron, and Cactus, even though Cactus is the market share leader, you see the brand image strength of SLB in the North America land market as it relates to technology. And you see how Cactus exhibits brand image strengths as it relates to field service. You can see that SLB has a very consistent pricing strategy where they're viewed as more of a premium supplier, costs more to be worth it, and SLB is not viewed as a discount provider. And you see the inconsistency of Cactus's pricing strategies and implementation that creates confusion in the establishment of their brand image in the marketplace. With that, let's dive into the competitive landscape for surface wellheads. Just check and make sure here. When we look at the market share positioning in U.S. land, Cactus remains by far the market share leader and continues to retain that market share leadership position, followed by SLB Cameron, Vault, Streamflow, and others. When we move into the Canadian market, Streamflow is the market share leader, followed by Great North. We move internationally, Schlumberger SLB Cameron is the market share leader, followed by Technip FMC and Baker. And when we move into the offshore for dry surface wellheads, Cameron's the leader, followed by Technip FMC. When we ask the oil and gas operators to rate the performance of the wellhead suppliers on a scale of 1 to 10 on these 7 performance factors: responsiveness to needs, equipment quality, competency of field personnel, technical support, availability, operational advantages, being able to quick connect systems, being able to save time on installation, and pricing competitiveness. We really see a pretty wide variance in performance between the various surface wellhead suppliers. We certainly have no evidence based on the feedback from the oil and gas operators globally that the surface wellhead suppliers are all viewed as performing homogeneously the same. In fact, when we start to benchmark the trends, the performance trends for the industry, and we look at the performance reviews of various suppliers year on year, since we update these surveys year on year, and like I said, these trends are based on 2,000 customer reviews and 80,000 performance ratings to prepare these trends. Well, the point here is for the oil and gas operators, not all oil field service company suppliers are performing at the same level. And as an oil and gas operator, you really need to collaborate with your oil field service company suppliers to understand each of their strengths and weaknesses to see how they can best deliver the best value for you. You'll notice that some suppliers consistently rate maybe below the industry average, the dash line, some consistently rate better. And depending upon the factor, be it field service or technical support or equipment quality, you'll see variances in performance. When you move internationally, you'll see how Schlumberger Cameron consistently rates better than industry average for equipment quality and field personnel and technical support, but their responsiveness to customer needs is only about industry average. And again, similarly, when you move offshore, you'll see how Technip FMC and Schlumberger Cameron are really starting to perform at similar levels based on the feedback from the oil and gas operators operating offshore. So when you translate this to the value map that we spoke about earlier at the beginning of the webinar here, you can see that in the U.S. land market, Cactus is very well positioned and viewed as delivering strong value, and followed by Atlas and Vault and Encore, who are also viewed as delivering really good value. Schlumberger's SLB Cameron, they do cost more and their value propositions being challenged in the marketplace. When you move into Canada, Streamflow is the market share leader and viewed as delivering good value. You see SLB Cameron and Great North in ability to compete against Streamflow is trying to offer more attractive pricing to compete against Streamflow, who's very dominant in Canada with about 50% market share. When you move internationally for surface wellheads, we find that Schlumberger Cameron is the premium-based supplier. Technip FMC is more viewed as a value advantage supplier. And although Baker Hughes is underperforming industry average, they are viewed as delivering good value and meeting overall operator expectations. In the international land market, the small regional players that we aggregate together as all others are viewed as the discount provider. They perform below industry average, but they offer attractive pricing to try to offset their performance shortcomings. As an oil company, before you accept a discount provider who has performance shortcomings, I think it would be good to conduct due diligence to understand exactly where these performance shortcomings are coming from and whether or not those performance shortcomings would be acceptable to your operations. In many cases, sometimes it's better to pay more to get more. If you pay less to get less and you get what you pay for, oftentimes that may work too. It just depends on the application. When you move into the offshore market, we see clear differentiated value from the oil and gas operators operating offshore. They clearly see SLB and TechnipFMC as the premium-based suppliers. Pay more, get more, but you get what you pay for. And they also see a series of discounted providers. Pay less, get less, but you get what you pay for. But you must understand your trade-offs in order to make sure that you're getting best overall value for your project. When we move to subsea wellheads, what we find is it's pretty much a three-horse race for market share between Baker Hughes, TechnipFMC, and Drillquip, with TechnipFMC clearly positioned as the premium-based supplier, Drillquip positioned as the value-based supplier, and Baker Hughes, who's also a premium-based supplier, but whose value proposition is being challenged by the subsea oil and gas operators. We do see differences in buying behaviors or influences in recommendation. In the United States land, the U.S. land operators tend to segment. Some U.S. land operators tend to value price in the selection of a wellhead supplier. Others value quality service. Others value technology and performance. As you start to move into Canada, it becomes much more of a commodity price-driven market, whereas if you move internationally, you see segmentation, and you move offshore, you see quality, service, and technology are viewed as being more important than simply the lowest price amongst the offshore operators. When we move into the cementing services competitive landscape, Halliburton, Big Red, is the market share leader in the United States land for primary cementing services, followed by SLB, American, which is formerly BJ, Nine Energy, and NexTier. When you move into Canada, you have far fewer suppliers, with Trican and Sangel dominating the market in Canada. When you move to cementing services internationally, what you find is Halliburton retains the market share leadership, followed by SLB, and the same for the offshore market for cementing services. Again, we see variance in performance amongst the cementing service suppliers. We don't see any evidence that the cementing service suppliers are all performing at the same level. Again, requiring operators to do proper due diligence in order to identify best overall value for their wells and applications. When we move ahead to the value maps for cementing services, what we find in the United States land market, Compass, which is a smaller supplier with new equipment, viewed favorably, along with a host of other small to mid-tier suppliers, including Spinnaker, NexTier, Universal Patterson's grouped in here with the all others, are all viewed as delivering pretty good value for the dollar. Halliburton and SLB's value propositions are being most commonly challenged in the United States land market. When you move into Canada market, the Canadian market, Trican is outperforming Sangel in the eyes of the Canadian oil and gas operators. And when you move internationally, you find that SLB and Halliburton are both viewed as premium-based suppliers, with SLB edging out Halliburton in overall performance. Baker Hughes solidly positioned internationally as well as delivering solid value. Note that the small to mid-tier regional-based suppliers are solidly positioned into this discount quadrant, where they underperform industry average, but they offer attractive pricing to offset their performance shortcomings. Offshore, you see Schlumberger, SLB, and Halliburton really going at it toe-to-toe on the performance axis, the horizontal x-axis. They both apply to the very similar spatial positioning, whereas SLB is viewed as having a little bit higher pricing versus Halliburton, and Baker Hughes is positioned as the discount provider. Moving into cementing tools, we find a completely different competitive landscape. In the United States land market for cementing tools, Weatherford's the market share leader, followed by Innovex, who acquired Rubicon, followed by Halliburton in third position. In Canada, Weatherford's the market share leader, followed by Import. Internationally, Halliburton's the market share leader, followed by Weatherford. And offshore, Halliburton's the market share leader, followed by SLB and Weatherford. When we take a look at the competitive landscape for cementing tools in the U.S. land market, what we find is that Innovex is very strongly positioned, is delivering really strong value. You may recall this is a very similar competitive position that Cactus holds for surface wellheads. And so expect Innovex to continue to protect, defend, and potentially grow their presence in the cementing tools market, because from the operator's perspective, they're viewed as delivering really strong value. Weatherford's a solid performer in the U.S. land market, but we do see a decline in performance over the last year or two, particularly in the last year for Weatherford in the U.S. land market, to where now Weatherford's value proposition is beginning to become challenged in the U.S. land market for the first time in the last several years. In Canada, Weatherford is very solidly positioned as the market share leader and kind of setting the tone for the market. Whereas internationally, we find that SLB rates favorably, followed by Halliburton as a premium-based supplier. Weatherford is viewed more as a discount provider for cementing tools in the international land market. Offshore, we find that Blackhawk is very well positioned as a specialty provider for offshore cementing tools. SLB and Halliburton are both positioned as premium-based suppliers. Weatherford's positioned more as a discount provider, and Baker Hughes as a value advantage supplier in the offshore market for cementing tools. Moving to the liner hangers competitive landscape, this has traditionally been a stronghold for Baker Hughes, and Baker Hughes continues to maintain market share leadership, followed by Halliburton and Weatherford on the North America land market. When we move internationally, Baker Hughes continues to demonstrate market share leadership, followed by Weatherford and then Halliburton in third place and SLB in fourth place. In offshore, Baker Hughes is the market share leader, exhibiting strength, followed by Halliburton and then Weatherford. Again, we see quite a bit of variance in supplier performance based on the feedback that we receive from the oil and gas operators that rate their supplier hanger, their liner hanger suppliers. Some of the biggest variances are observed in equipment quality and reliability, technical support, availability, and pricing competitiveness. In many cases, we see suppliers like Weatherford showing trends of improvement over the last several years in their ratings for liner hangers. And in many cases, we see Halliburton had some years of performance growth. What we do see in this most recent year is that Halliburton's ratings in liner hangers have declined for responsiveness to needs and technical support, along with availability and even a little bit of personnel. So Halliburton's showing some declines in the last 12 months. Weatherford's continuing to show performance improvements over the last 12 months and the previous years. When you look at the overall competitive landscape for liner hangers, you'll find Weatherford well positioned along with a host of other small to mid-tier providers, including Innovex, who we spoke about earlier for cementing tools. Well positioned is delivering good value in the North America land market for liner hangers, well positioned to protect and defend current position. Baker Hughes, the market leader, though, is being questioned by the oil and gas operators on their value proposition, and we'll really need to continue to try to address those perceived performance shortcomings to defend their current position in the market. Internationally, Weatherford is viewed as a value advantaged discount provider and viewed favorably and performing on par with some of the larger players like SLB and Halliburton and Baker Hughes. Baker Hughes is the market share leader, but again, the value proposition is being challenged, whereas if you move into the offshore market, you can see how dominant Baker Hughes' market share and competitive position is, well positioned in the offshore market to protect and defend. Now, in the offshore market, Weatherford is more viewed as more of a discount provider, meeting operator expectations in terms of value, but not necessarily viewed as the performance leader. So I think we covered a pretty good overview of the competitive landscape for surface wellheads and cementing services and tools and for liner hangers. Certainly glad to address any questions that may come through the chat box. I guess to kind of wrap things up here a little bit, some key trends I think that you may want to keep an eye on for 2023 will be really just the discipline by both operators and service companies alike. We certainly don't want to see the market continuing to grow for growth's sake. We know we've been underinvesting for the last several years, and that we need to increase investment in the oil and gas industry just to meet demand, to make sure we have affordable and accessible supply. I think we've all witnessed in the last year how important it is to have accessible and affordable energy and energy security. So with current policy in place that is supportive of higher oil prices, the oil and gas industry should be a very vibrant and healthy market moving forward. The capital discipline and focus on shareholder returns should be the guiding light for the industry, for both operators and service providers. I'd also like to emphasize again how important it is for the oil and gas operators, particularly in a tight market for oil field capacity, to collaborate with their service providers to make sure that everyone is kind of in sync, if you will, with the timing and the needs for technologies, equipment, and personnel and investment, and making the necessary commitments mutually long-term so that oil field service companies can commit resources to be there for the oil companies to meet their investment needs. We will be having some updates coming up here soon, probably later in the month of March, perhaps, dealing with formation evaluation services, as well as some updates on intervention services in April. So if there's not any additional questions, I'd like to thank everyone for attending this webinar. I appreciate all the participation from the oil and gas operators in these industry surveys worldwide. Please feel free to reach out to Kimberlite should you have any questions. And thank you so much for attending. Thanks. Bye now.